Like I was saying, the tendering process involves a lot of costs. So you should make sure that you set it up in such a way that at least you're able to justify the cost by being able to select someone suitable. The tendering process should be broken down into the following stages. Number 1, you collect background information about the possible new clients, or assuming that a firm is submitting a tender for the audit of a new client. So you have to collect background information about the possible new clients. You need information about them. You need to also establish the precise scope of work to be performed. What is the scope of work to be performed here? What is the scope of work to be performed? You need to establish that. Then you need to carry out a preliminary audit risk assessment and prepare a preliminary plan for the audit. You need to do some initial, when we say preliminary, it's an initial audit risk assessment for the audit to understand, the likely risk factors in the audit. This is nothing deep. This is just preliminary. And this must cover the staffing requirements, how many people you need to do the audits, and the time requirements for the work. You need to have all that estimated. Then after that, you can estimate a fee. Then you prepare a submission document for the potential clients. Then if it's required, you need to give a presentation. Okay, so looking at our circumstances, this is the number. We need 5 members on the team. These 5 members of the team will be working 5,000 hours from April to June. And, basically, yeah, this is essentially what you're saying. And these are the steps that you need to take note of or look into. Any questions so far?
No, sir.
Okay.
So I want to ask something with regards to
Okay, go ahead. I'll say any questions so far. No one will mind me. And I'm moving on. Let's say question. Anyway, go ahead.
Okay, so I want to find out, is it ethical to use the revenue base of a particular company, like to use that in determining fees, fees for an audit work? Is it ethical to use that?
Okay,
because
that's a good question. Okay, go ahead.
So, because from what we are looking so far, I see that we look at the cost to the it's like cost plus markup or cost plus margin.
Yes, a cost plus method.
Yes, so they are looking at their cost and then they put their margins on that. But is it also ethical to be looking at it from the view of the company, whether they have, looking at their revenue base, whether they have the means to pay for that fee? Yeah.
Okay, class, what do you think?
So I think it will lead to an impairment in their independence if they look at the organization's revenue, like they base their charges on the organizational revenue. Because if there are issues with the revenue, because their fees are linked to that, I think it will lead to some ethical issues.
See, any other alternative views? Or any other supporting views, please? Any other views or alternative views? Our brother is saying that. Is it okay? Is it okay that you price or you charge clients based on their revenue? What do you think? Hey, no one will mind me.
Hello. Hello.
Yes.
Yes. It's not okay. So when I believe that the size of the firm would determine the size of the company's revenue. Now, if you are dealing with a relatively big firm, what is happening is that there is also relatively big work. So indirectly, not directly as you are looking at revenue base, but then revenue base that has a relation with the size of the firm would still directly or indirectly influence the charge, because it looks like now you have relatively big work to do compared to a firm that is very small that generates very small revenue.
Okay. So your conclusion is it's not good.
If it is not in excess of the percentage you're not supposed to meet, then there's nothing wrong with it, because it would still come back to the size of the work you are doing.
Oh, okay. Those are some interesting views right here. So to answer your question, right, when you are going to submit a fee to a client and you go there and you tell them, oh, they'll ask you, when you tell them, oh, you charge $30,000 or $100,000, they don't just accept it. They want to know how you came up with that number. So if you came up with that number by, let's say, multiplying 10% of their revenue, which is 1 million, they'll want more explanations on that. They'll want more explanations. That's why a lot of audit firms use the hour method, and the people working on the team. The time-based method. The time-based method. Because just charging, you just don't charge someone because their revenue is big. Maybe the work you are doing for them is small. So you don't just charge big, because it's not like Cantamanto, right? Where people charge more because they see, when they look at you, they see that you have more money. It's not. There has to be a methodical approach to charging. So that's why they use the time-based approach. Because the company might be, let's say, Apple, $1 trillion company, or a company that has $200 billion in revenue. But maybe the work you are doing for them is extremely small. It's not that huge. So you can't just charge them based on revenue like that. You charge them based on the work you are doing. That's essentially what I'm saying. You charge them based on the work you are doing. And there has to be some logic to how you came about that charge, basically. I hope that makes sense.
Yes, please.
Okay. Fantastic. Now let's talk about how to evaluate the tender. In evaluating the tender, the company is likely to consider the following issues. They'll consider fees, right? So for the one who was asking, is it not a bad thing, like if they're only looking for fees? Usually it's expected that companies will consider a lot of things apart from fees. But sometimes money can usually play a huge role here. So number one is fees. Number two is the services that the firm is able to provide, right? Number three is the geographical locations and coverage of the firm's offices. So this will usually apply to multinational firms, right? The reason why multinational firms will go with the big four companies rather than other, that's why you will not see in Ghana you will not see maybe Vodafone being audited by AB and Co, a local chartered accountant audit firm somewhere, because they don't have presence in South Africa. They don't have presence in the UK. So how do you expect them? They would rather go with someone who has a lot of geographical locations and coverage. Another thing is the expertise of the firm and its staff and the reputation of the firm. These are all things they consider. They don't only consider fees. But sometimes like money can play a role. Money can play a role. So fees, the services, the geographical location, the expertise, and the reputation. These are all things that are considered. Now, there's a term called lowballing. Lowballing is the practice of tendering for the audits work at a very low fee. And that was what I was explaining that some audit firms do. You tender for the audit at a very low fee. So you know that maybe you are competing with, as a local audit firm, you are competing with PwC, EY, Deloitte, and KPMG. You know that, you can't compete with them. So what you do is, if these firms are charging averagely 50,000, you say you charge 30. And it is done with the goal that they will just enter the market. It's a pricing strategy, where you price low so that customers will be attracted to you for those doing strategy. So you price low so that you'll be able to raise the audit fee in the future years. So once you are accepted, Kim, then in future years, you can raise it. Or also, once you get in, you can be provided other non-audit services as well that can make you money, So that's a strategy. It's called lowballing. You charge low audit fees. Low audit fees. Any questions here? Please ask questions. The more you ask questions, the more you're able to remember, the more things stick in your mind. Because going through the audit book alone, it can be very boring. So if you have any questions, please ask. I'm continuing, but you can stop me if you do. Let's talk about credit control within an audit firm. An audit firm does not just charge fees. When it charges fees, it has to collect the fees that it charges, Say you've charged a fee, but as to collection, that's a different thing. It has to collect the fees that it charges. A failure to invoice clients promptly or a failure to collect payments within a reasonable time after the invoice date will be an indication of poor credit management. Yeah. So if you don't invoice the clients properly or you don't collect your payments after a reasonable time period, all these things are poor credit management. Occasionally, non-payment of fees may be due to the fact that the audit client is in financial difficulties and cannot pay. So there are situations like that where the client is, in a dire financial situation and may not necessarily have the funds to pay. May not have the funds to pay. That's a huge problem. That's a huge problem.
This is interesting. If you don't have the funds to pay, why do you engage them?
Yeah, things happen, Yeah, things happen where businesses, this happens maybe at the beginning of the year, because engaging them might happen at the beginning of the year. Let's say it's a new client, right? It's a new audit. Yeah, so at the beginning of the year, everything might seem fine. Then maybe during the year, things become difficult. Let's say coronavirus happens. When coronavirus happens like this, a lot of hotels and those in the hospitality sector began to suffer greatly. So it's not intentional that they won't pay. It's just that some things, unforeseen circumstances, or what they call the force majeure, unforeseen circumstances. Sorry?
Yes, that's correct.
Yeah. Unforeseen circumstances can happen during the year that changes the dynamics of a company's revenue stream. Overdue fees are a threat to the independence and objectivity of the auditor. Why do you think so? Why is overdue fees a threat to the independence and objectivity of the auditor? Any idea? Why do you think overdue fees, if a client is not paying the fees, why do you think it's a threat to independence and objectivity?
So I think that it will impair the objectivity and independence of the firm, because they think that if they don't kowtow to the whims and caprices of the organization, they will not get paid. So let me just do what they want me to do, and let me get paid and just go my way.
That's a good point. That's a good point. Or they can also say that in order to get you to pay, if you don't pay, we will punish you in the financials. So it can be two-way. It can be two-way. But what you talked about is a lot more realistic. It's a lot more. So it can impair the independence and objectivity, because it might be argued that the audit work has been done free of charge. If the unpaid amount has been overdue for a long time, it could be regarded as a form of loan by the audit firm to the client. If fees are unpaid, when unpaid fees are owed by a client and the period of late payment is in excess of what might be regarded as reasonable or commercially acceptable, the audit firm should consider whether it would be ethically appropriate to resign. So if the client is owing the auditor for too long, it's just too long. Yeah. The audit firm should consider whether it will be ethically appropriate to resign as auditors. The ethics partner of the firm should be asked to assess the ethical threat to the firm's independence and integrity, in such situations, because it's definitely going to have an impact. If the decision is to continue as auditor of the client, the reason should be documented. It should be documented. Very, very key. If the decision is to continue as auditor, the reason should be documented. The most recent audit paper should be checked to ensure that sufficient appropriate evidence was obtained to support the going concern assumption in the financial statement. So basically, if the payment of fees is taking too long, right, the auditor should begin thinking that, do we have to resign in this case? Do we have to resign? And is it ethical to resign? Any questions so far? Hey, today there are a lot of people in the class. Huh? What happened last week? Or is just me? How many people are usually in the class? 20 people?
Around 16, 15, 16.
Oh, okay. Wow. That's interesting. Any questions? Okay, if there are no questions, I'm moving on to the next slide. Agreeing the terms of the audit engagement, ISA 210, the objective of the engagement letter. The objective of the engagement letter, the objective of the auditor per ISA 210, agreeing the terms of audit engagement, is to accept or continue an audit engagement only when the basis upon which it is to be performed has been agreed. Right? So you only accept or continue an engagement when there's a basis for it, and this basis will be clearly visible, clearly visible. That's the word. This is done by establishing whether the preconditions for an audit are present, confirming that there is a common understanding between the auditor and management, and that the auditor is required to refuse the engagement where there's a limit. Okay, so let me explain the first part of it. So when we talk about an engagement letter, an engagement, it's one of the key things in audit. It's one of the key things in audit. So it's something I would want to explain extensively. So when we talk about the engagement letter, it's simply a kind of like a binding document or a contract that defines the relationship between an audit firm and its clients. So when we say an engagement letter, it means that one person is engaging the other. It's not like marriage here, but it's an engagement letter. The engagement letter, it documents and confirms the auditor's acceptance of the appointment, the scope of the audit, the objective of the audit, the extent of the auditor's responsibilities, and all that. It documents all of that. So that common understanding between auditors and management has to be established. The auditor has a right to refuse the engagement where there's a limitation of scope that is imposed by management themselves. Does anyone have any clue what limitation of scope is? Limitation of scope. Let me say a limitation of scope in audits. What does it mean?
So can we say that it's when the audit process or the work, the engagement that the auditor is supposed to do has been curtailed or is being blocked by some occurrence?
Correct. It's being restricted. So things like you are trying to get information or the sufficient and appropriate evidence to be able to audit your financial statements, but you try. Management is not giving you that information. They are blocking it. They are restricting, the performance of your audit duties or your audit work. That's a limitation of scope, and therefore you'll not be able to express an opinion because you don't have any evidence to express opinion. The auditor is also required to refuse the engagement where the financial reporting framework to be used in the preparation of the financial statements is unacceptable. It's unacceptable. That's also another thing. And when management does not agree to the above responsibilities, because management must know their responsibilities in the engagement letter, and auditors must also know their responsibilities. So when management is saying, oh, we don't agree to the above responsibilities, then the auditor must beware. Because management has responsibilities. They're supposed to prepare the financial statement. They're supposed to do a number of things which we talked about in, I think, our first lecture. So what is in the engagement letter? Number one, it includes the objective and scope of the audit. It defines the boundaries of the audit. Number two, the responsibilities of the auditor. What are the auditor's responsibilities? Number three, the responsibilities of management. Number four, what kind of financial reporting framework are we using here? Number five, reference to the expected form and content of any reports to be issued. So these are some of the things that should be in the engagement letter. So let me ask this question again. Who has the primary responsibility to detect and mitigate fraud? Please type your answer in the chat. Who has the responsibility? Okay, let me see some of the responses we have here. Management. Okay, that's absolutely correct. That's a trick question, so I wanted to be sure everyone has it at the back of the mind. Okay. Any questions on this slide before I move on? Any questions on this slide?
No, sir.
Okay. So let's talk about the annual review of the engagement letter. The annual review of the engagement letter. The engagement letter that is issued on the initial appointment of the firm may specify that its provision will apply to all future audits until it is revised. Sometimes the engagement letter has to be reviewed because the responsibilities might change, even the scope of the audits might change and all that. So, things change. So, however, ISA 210 requires the auditor for requiring audit to assess whether the circumstances mean that the terms of engagement need to be revised. The terms of engagement need to be revised. Number two, management need to be reminded of the existing terms of the engagement. So there are times when the engagement letter is reviewed. Now let's talk about accepting a change in the terms of the engagement. The entity might, in certain circumstances, ask the auditor to change the terms of the audit engagement. This might result from a genuine change in circumstances, like I was saying. It can be a change in scope, a change in responsibilities, or from a misunderstanding as to the nature of the audits as originally requested. So there are situations where there might be a misunderstanding. There might be a misunderstanding. If there's a misunderstanding, that could also cause a change. However, it also could result from a situation where the auditor is unable to obtain evidence, like the one we are talking about regarding the material item. The entity might then ask for the audit engagement to be changed to a review engagement to avoid a qualified opinion or a disclaimer of opinion. So that's something the entity can do. They might ask that, oh, change this from an auditor engagement to just a review engagement so that they don't get a qualified opinion. ISA 210 requires the auditor to consider the justification for the request and whether it is reasonable. If the auditor considers that it's a reasonable request, then the revised term should be agreed and recorded. But there are some times when it's reasonable, to change the terms of the engagement. Like I said, there might be appropriate justification for it. If the auditor is unable to agree to a change of terms, he should withdraw from the engagement and consider whether there's any obligation to report the circumstances to those charged with governance. In situations where the auditor is unable to agree to a change of terms, it's clearly stated here under ISA 210 that they can withdraw from the engagement and consider whether there's any obligation to report such circumstances to those charged with governance. Are there any questions on this, please? This is agreeing the terms of the audit engagement. Okay, it looks like there are no questions. So let's move on to audit strategies. For those doing strategy, I think this, how many people are doing strategy? If you are doing strategy,
So
please.
one question.
Okay.
Yes, on the agreeing to the terms of the engagement, if there are any, let's say, misunderstanding or renegotiating on the terms of the engagement, must it be documented?
When you say must it be documented?
Like the reason for the renegotiation of the, or it can just be like more or less like a verbal something. It must not be documented or something.
Oh, I see what you mean. Yes. So if you're having issues, right, you should document it. You should document it. You're talking about a disagreement, right?
Yes, sir. Yes.
Yeah. Yeah, disagreement should be documented so that the reasons, especially in cases where it leads to the auditor withdrawing from the engagement, it should be documented so that in any case, anyone who picks the report knows that, oh, so and so happened. And so Mr. So and so auditor had to leave. Yeah, quite simple. If you are taking sorry?
Oh, sir, please go on.
Okay, if you are taking strategy, please say in the comments. I just want to see how I should approach this. If you are taking strategy, say yes. If you are not taking strategy, say no. With SWOT. Just in the chat. Please, there are 15 or so people. Yes, yes, no, yes, no, yes. Hey, wow, then a lot of people are here taking strategy. Okay. I guess I must take my time to go through, but those who are doing strategy, some of these things might be familiar. Might, not necessarily. So a choice of audit strategies. An audit strategy is the overall approach that the auditor decides to take for an audit. That is the approach the auditor decides to take for an audit. And it is from the audit strategy that a detailed audit plan can be formulated or developed. Very, very crucial. Very, very crucial. Very, very crucial. Very, very crucial. There are several possible audit strategies that are available. Number one is what we call the business risk approach or the risk-based approach. Number two is the system-based approach. Number three is the substantive testing approach. Number four is the statement of financial position approach, which is usually used by small entities. Now, let's look at a summary of all these approaches. The statement of financial position approach. This audit approach concentrates on the statement of financial position, which is the balance sheet figures, using substantive testing. On the argument that, so listen to the rationale behind this. If the opening and closing statements of financial position are accurate, then the profit or loss for the year must also be accurate, right? So you see the logic here. They're arguing that if the opening and closing financial, opening and closing balance sheets are accurate, then the profit or loss for the year must also be accurate. Does that make sense? Or it doesn't? Please, let me know if it makes. Sorry?
To some extent, yes.
I think it does, yes.
Yeah, to some extent, yes. It's an interesting approach.
Yes.
Because once your opening and closing balance sheet values are accurate, then your P&L must also be accurate, because your profit numbers go into your balance sheet. You know, they're kind of like connected. So that's the statement of financial approach. It uses substantive testing, but in a more limited fashion. Now let's talk about substantive testing itself, the substantive testing approach. This approach focuses on applying substantive tests to a large number of transactions. So those who are doing audit here, when you say substantive testing, you are testing account balances in the financial statements. So this approach focuses on applying substantive tests to a large number of transactions and account balances, you see. So you are testing transaction and account balances recorded in the accounting system of the client. So that's substantive testing. That's substantive testing. So you are testing balances and transactions. Then you have the system-based approach. The audit focuses on the application of the test of controls to the systems that produce the figures in the financial statements, rather than on the figures themselves. So here you are looking into the test of control systems, test of controls. All these are audit strategies. All these are audit strategies. Risk-based approach and business risk approach, or business risk approach. Yeah. This is an assessment. An assessment is made of the likelihood of material misstatements existing in each area of the audit. So here you are approaching things from a risk perspective, right? From a risk point of view. So here you look at the likelihood of material misstatements in each area of the audit. Areas that are addressed as high risk are audited extensively. So this is a risk-based approach. You audit extensively. Areas that have a low risk are given low level of attention, right? So the areas that you look and you see that the risk is very, very high here, you audit extensively. You use substantive tests, you use analytical procedures, you do a lot of system-based approach testing or control testing there.